If you are in the market to buy a home this year, you may be kind of confused about how much money you need to put down on a home. Many people that you talk to will tell you that you need at least 20% down to be able to secure a mortgage. Now that's just not true. However, if you can afford it, here are the top 4 benefits of putting 20% down on your next house. So right off the bat, number 1, your interest rate will be lower. Putting down a 20% down payment versus say a 3%, 5% down payment, it shows your lender, it shows your bank that you're much more secure, you are much more financially stable, and thus a good credit risk, improving your chances to have them fund your loan and handle your finances. Tip number 2, or you'll end up paying less for your home. The bigger your down payment, the lower your loan amount will be for your mortgage. So if you are able to pay 20% of the cost of your new home at the beginning of the transaction, then you will only pay interest on the remaining 80%. Conversely, if you put down, say, 5% down, well, then the extra 15% on the loan will accrue interest and it'll end up costing you more for your home in the long run. Tip number 3 out of 4, personally, my personal favorite, your offer will stand out in a competitive market, which is what we're in right now. In a market where many buyers are competing for the exact same house, sellers like to see offers come in with 20% down or more. The seller gains the same confidence that the bank did, that the lender has who's financing your loan. You are seen as a stronger buyer whose financing is more likely to be approved. Therefore, the deal will most likely go through. Sellers like to have that confidence, and when they see you put 20% down or more, they know that you're a solid buyer. And number 4, you will not have to pay PMI, or private mortgage insurance. What's PMI in a nutshell? PMI is simply an insurance policy that protects the lender in the event that you cannot make your mortgage payment. It's a monthly fee that's rolled into your mortgage payment. So when you put down less than 20% down, lenders, banks see that as a bigger risk, so they have to put a PMI into effect in the event that you cannot pay your mortgage. It's an insurance policy for the lender. Now, on the other hand too, if you're looking to buy your very first home, you'll have to kind of weigh the options of putting a 20% down payment versus the time and cost of continuing to rent while you save up the amount of money that you need. So here's the bottom line. If your plans, your future plans, include buying a home and you've already started saving up money for the down payment, then let's get together and decide what down payment program fits best with your long-term goals. I'm Ryan the Realtor. I'll see you guys next time. If you have any questions, let me know. If not, I'll see you on the next video.